Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Treasury Update podcast. I'm Craig Jeffery, your host today. Our episode is called Controlling the Controllables, Treasury Insights with Bank of America. And I'm joined by Sue Caras from Bank of America. Sue, it's so good to have you on the Treasury Update podcast.
Craig, thanks so much for having me today.
This is our first time on the podcast. We've spoken a number of times, but I'm really excited to talk about this. You know, this idea of controlling the controllables comes in the context of volatility. And I wanted to get your thoughts on how you look at the volatility of the current economic environment, geopolitical environment. Is it calm? Is it turbulent? Are we facing extreme weather? And then maybe share a little bit about what you see as contributing to the whatever that status is that you give it.
Well, I think it depends on the day. I think any given day can feel calm, turbulent, or extreme weather. I'll touch on 2 points. It would be amiss to not talk about tariffs. Everyone is clearly talking about tariffs. It's in the news cycle every day. And the best guidance and advice that I could give to any corporate is it's uncertainty that drives extreme weather. And once things become clearer, corporates can really plan for this. We need to always remember that change is constant. Today, it might be tariffs. In 2026, in 2030, it could be something totally different. So it's important that we take a longer view of business cycles and that we think about uncertainty as an opportunity to plan. Corporate survival isn't predicting these events. It's not thinking through what could potentially happen in 2030. It's making sure that we prepare for them with fundamental discipline around the business. So when we think about forward-thinking conversations and not reactionary ones, we help our clients navigate these challenges through thinking about trade and tariff shifts, discussing topics such as inflation or interest rate volatility and the impact that could have on their business, and really helping our clients think through the strains that this might put on their business. Liquidity, supply chain, volatility around FX and conversion rates, and helping our clients think through the modeling and doing the stress testing on what impact that could have on various aspects of their business. So I think that's tariffs. The second item that I think is really important is the industry is changing really quickly. And I often say this is no longer our father's or our grandfather's treasury business. You'll have to excuse the expression on that one a little bit, but a lot has accelerated in the payment space since the pandemic, particularly from 2020 to today in 2025. We've had the rise of real-time payments in FedNow. We just went through an industry-wide migration on ISO. We've had clients shifting to embedded finance and APIs. And all of this takes a visionary view of where the business is going, quite frankly, where the puck is going for your business, and making sure that you plan and you organize around it. So 2 common themes there, both have to do with preparedness and really helping to think through how we can become better organized and the infrastructure that is required around that governance process.
I liked how you talked about both the economic impact or the potential of tariffs, and then you brought in some tech and changes on the payment side. That's pretty interesting. And you mentioned a couple new payment rails, RTP and FedNow. Is that just complexity in the background, or does that present opportunities for better planning, better operations?
I think it creates a tremendous opportunity. If we think about real-time payments, the volume of real-time payments has grown in the US by almost 60% in a very short period of time. Now that said, it is still a very small subset of total payment volumes. But with real-time payments, it's the instant transmission of funds. But the benefit of real-time payments is really the rich information that comes with an ISO format. And that's allowing clients to drive greater data in their operations, better liquidity, better funding decisions. And there's a whole subset of the economy where a payment rail like ISO and real-time payments, particularly in the gig segment, are essential to the success of how those businesses operate.
Thanks for that. I'd love to dig into that a little bit more in a bit, but the next question I wanted to ask you was about what can companies do in these turbulent times, whatever the level of turbulence, calm, turbulent, extreme on any given day, in the context of what can be controlled and what is something that people react to. And you talked about the fundamentals and not necessarily being able to predict exactly what could happen. So maybe you could share it in that type of maybe calibrated response of what can be controlled, what can't be controlled, and how do we adjust for that?
In the world of what Treasury can control, liquidity management is probably the most important. Having a solid Treasury forecast, refining it for both short-term and long-term to ensure visibility, making sure that there are adequate liquidity buffers, that is essential. The second, probably most important thing is risk management. Have you revisited your hedging strategy? How are you thinking about interest rate exposure? Potentially, what's your counterparty risk? Third is capital structure, thinking about debt optimization, making sure that you have sufficient liquidity on hand, improving DSO and DPO, inventory turnover. All of that's critically important. And probably the last one in what is controllable and something that we see a tremendous uptick in client conversations around is just technology and process improvements. How do you automate your payments? How do you improve the speed of reconciliation and reporting? I mentioned earlier the real-time data that drives decisioning and scenario planning. And of course, a really tight strength and control environment around cybersecurity and financial assets and data. All of that is controllable. All of those would be industry leading best practices. What Treasury cannot control for, those are microeconomic shocks. Could be spikes in inflation, geopolitical tensions. But you can model for these scenarios. You can prepare for contingency. The second one, we can't control for market volatility. In most cases, FX rates, interest rates, all of that is out of our control. Regulatory changes are out of control, but we must stay agile and adapt quickly to the changing legal environment. And finally, customer and supplier behaviors. All of that is somewhat, to a certain extent, things that are beyond the control of the Treasury Department. But the proactive measures that any department puts in place, the proactive measures around scenario planning, policy review, stakeholder communication. At times of volatility, it is more important than any other cycle to ensure that the CFO, the board, and business units are all well informed and they have clear insights.
So you mentioned insights a few times, and that's one of the titles, right? Treasury Insights with Bank of America. And you talked about a couple of things that I'm going to come up with a question from this, but let me say the things as I'm thinking through them. One is you talked about data. When you talked about faster payments, you said it's not just more rapid. It's richer data, meaning you can do more with it. You can forecast more. So that tied in with the data. And so there's a level of data. You talked about efficiency as well in the business process and how important that is. It seemed like you were talking about making an organization that's flexible and adaptable. How important is the efficiency part of that, the business processes that they're scalable, let's say, compared to keeping the board informed? Not that they're one against another, but what would be a priority or a weighting that you would give that?
Listen, I cover the middle market segment. And what I can share with you from experience is Treasury departments are thin, right? They typically tend to be, 3 to 5 people. Larger global multinationals have bigger, more robust Treasury departments. But efficiency is everything. When you think about a process improvement and then you apply technology on top of that, that optimization, the efficiency that happens through taking hours out of the workflow, being able to redeploy that time to another process improvement, that is critical to success of the business, because there just simply aren't enough people. When you have people that are manually ticking and tying reports, or they're having to extract data. We had a client that I once asked how they did their cash forecasting. And he said to me, "We have full global liquidity over our cash." And I was somewhat surprised by that, because they were operating in nearly 60 countries around the world. And I later learned that his local teams were writing down their cash balance on a piece of paper at the start of each day, and they were faxing it to headquarters, and somebody was manually typing that in. And I thought to myself, well, not only is that a practice that is, potentially fraught with ways in which you could commit fraud, right? Internal fraud. It doesn't really give you that visibility you need. And I think about just the amount of manual hours. And so we helped that company create and establish a cash forecast that was fully automated, connected into their bank portal, and the CFO got an alert every day of what their cash position was around the world. And I just, these process improvements, they happen sometimes in little incremental improvements, and sometimes there's just a total overhaul of a process altogether, and you can apply automation and digitization around it.
I think that's a really, really good example. It's like, yeah, we do have global visualization or visibility, but it's the worst way of doing it possible.
It's the worst way of doing it. You said it, not me. The worst way. I was like, not only is that not an industry best practice, I feel like I need to send that case study to every other corporate around the world and say, please don't do it like this.
There is a better way, and that frees up time to manage those risks, or look at those, or do additional modeling, where if you're spending time doing that, it doesn't exist. We haven't done a formal introduction. I was wondering if you could introduce yourself to the audience. Tell us a little bit about your background and your role and remit at Bank of America.
So I am the head of our global commercial banking business for Bank of America's Global Payments Solutions Division. I'm based in Washington, D.C., and prior to this role, I've worked at the bank for nearly 3 decades. I've lived in many U.S. cities. I've worked in different divisions of Bank of America, and I've also worked and lived abroad. We lived in Pretoria, South Africa for 3 years. I lived in London for 3 years. And today I have the great privilege of leading our middle market treasury professionals that cover US and Canadian headquartered clients. We have subsidiary teammates that cover the subs of our corporates around the world in UK and Europe, Asia Pacific, and Latin America. In total, it's a team of, in my division, of over 500 people. And we have the great privilege of helping our clients think about ways to optimize their payments and their receipts and their liquidity structures, and improve operational efficiency and digitize their workflow, as I just discussed, helping to think about ways to reduce risk and fraud and FX strategies and navigate these very complex environments. I feel really fortunate to work alongside these professionals. They're passionate about what they do. They truly love helping our clients modernize their payment infrastructure and adapt what is the most cutting edge technology that's out there. But we meet clients no matter where they are on their continuum. The ones at the one end, right? We're just faxing in the corporate liquidity, all the way to clients that want to get to an optimal state where no one is hand touching a single piece of paper as it makes its way through the AP and the AR process.
Yeah, thanks for sharing that. So as you were talking through that, I have this view, I don't know if you hold it, that corporate America, the commercial-sized organizations, the extremely large small businesses, right? Small, medium businesses to commercial clients may have it harder than the larger ones because they have more resources and the smaller ones have far less complexity. And the middle space has almost the same complexity as the largest organizations and has a quarter of the resources. And so it seems like it's your role and your team's role is particularly important in helping that huge middle.
Yeah. Yeah. The other thing I would just say is when you think about the middle section of the market, we define middle market by global multinational companies that have sales turnover between 50 million and just north of 2 billion. A little bit wider of an industry stance than I would say the traditional industry definition of a middle market company, which tends to be, that 10 million to 50 million. So we really slant at Bank of America to the more complex end of the market. And in addition to the size of the Treasury Department or an accounts payable department or the receivables department, I think the other really big difference is the middle market companies tend to not have the resources to hire and engage consultants. And I think that's where we play a really important role because we come in as an extension of the Treasury Department, and we're able to provide that advice and guidance and act in that role of a consultant in helping them think about their business.
Yeah, appreciate that. And maybe someday we should do a podcast and talk about the different size companies and how they're different. Like if you're 50 million to 2 billion, you probably see differences around the 250 million to 300 billion mark. There's a big transition of company sizes there. Then again, around a billion, 2 billion, 5 billion, 10 to 15 billion. There's all kinds of different demands and pressures. That would be a fun conversation.
It would be a great conversation. I will say the one difference is if we think about larger companies, they tend to be more global. So a larger, 1 billion to 2 billion multinational is most certainly buying, sourcing goods overseas. They're selling overseas. When you get to a $100 million corporate, they might be more domestic in nature. An interesting point, though, we see the full spectrum of digital adoption. And part of that is sometimes the larger you get, you're dealing with different instances of ERP systems, right? You've grown through acquisition, and integrating all of those acquisitions into a common platform can sometimes be more challenging than a newer company that's able to start right out of the gate with full API integration, as an example. And you have one instance of an ERP, everybody's operating on it globally, and it provides you that real-time information.
That's excellent. As we planned for this, one of the questions I said I was going to ask you was to come up with anecdotes or stories, because you speak to many companies as a consultant and a researcher. We do as well, and that's one of the most enjoyable things about what you and I do. But as you pull together some of the things you've heard and the learnings that you've had, I'd love to hear any tenor of the conversations you have that may be a certain level of concerns and how they address those, but particularly if you have any anecdotes or points that would be useful to some companies or many companies.
Yeah. Well, I think anybody that's listening to this podcast would be happy to hear that the Treasury leadership is no longer transactional. It is strategic. It is reliant on being agile and being a stakeholder at the table as we think about the growth of the company. There's been a real shift in decision making, and it's really the Treasury Department's responsibility to help guide leadership around uncertainty. Also to think about resilience and planning, whether that's liquidity or risk management, helping to balance priorities, strategic priorities. So the role of Treasury Department is shifting, and it's more forward-looking as clients think about or companies think about organic growth or growing through acquisition. I think a few anecdotes. And listen, I talk to hundreds of clients a year. My team talks to tens of thousands, but a few that come to mind, and that is forecast. Cash forecasting has historically been a pain point for clients. It's challenging. But if I think about an antidote, it would be clients that used to create forecasts weekly and now it's daily. We're able to do that partially due to the robust infrastructure of our cash portal and an embedded forecasting functionality that taps into the data and the money movement both in and outside of the portal using AI and machine learning. That would be one. We've helped clients think about and automating their payment flows. We've helped clients get to a tighter control environment and processing payments with almost starting in a manual basis and getting to almost 80% workflow improvement. We've helped clients navigate the compass of FX volatility and the impact on their business. But the one that I'm probably the most deeply passionate about is when we can help and think about how do you take a process that maybe is not working well today. Could be cash application. How do you take that cash application process and how do you improve the matching rate? And this is something that's historically been really challenging. We've got I'll use the manufacturing facility as a really good example, Craig. They were at a 40% match rate, primarily because of deductions in the inventory as the products shift, but also because their clients were bundling invoices and paying multiple invoices with these deductions built into it. And we were able to not only think about the Treasury workflow and enabling straight-through processing on the reconciliation process, but also overlaying AI and machine learning that tapped into their customer service group. And we enabled this company to get to a 40% match rate to almost a 95% match rate on cash application. So I don't know. I think the client antidotes are the most fun for us. It's at the heart of everything we do. We want to make it easier for our clients to operate their business.
One of the things that you had mentioned earlier was about planning and navigating volatility. That's been a bit of a theme in our discussion today, and controlling the controllables. If we focus on controlling the controllables and making sure that we focus on those and I guess being flexible for the uncontrollable, what are some final thoughts or final comments on that? And I'll just say this one thing. There's the 10 essentials for the outdoors. Like if you're going hiking, you should have protection from the weather, like, ability to get water, able to start a fire, right? If there's certain issues, right? You hope you don't have to use those, right? First aid. Are there 10 essentials for Treasury that you have, or how do you advise people further on controlling the controllables?
Okay, well, if it's survival in the land of corporate treasury, I would say it's got to start with liquidity management, right? That would be your fire. You got to have sufficient fire. You got to have sufficient cash. So whether that's the core, ensuring there's sufficient liquidity on hand, or real-time forecasting for that cash, as you get to become a more complex multinational, right? You think about pooling or an in-house bank. On that same theme, probably the second would be cash forecasting. How do you think about your weekly, daily, monthly forecast? How can you move from a spreadsheet to something that feels more robust, and integrating that into an ERP or a TM workstation? Probably next is the bank relationship, thinking through ensuring that you have the right account structure, rationalizing the account structure, making sure that it's optimal from the standpoint of control. Gosh, I feel like I'm on the late night host here with my top 10, although it's probably not as humorous. Risk management, FX, interest rate, commodity risk, we talked about that earlier. Working capital, critical to the success of any company. Technology and automation, both basic automation, robust ERP modules. Capital structure, control and compliance, and governance. And then probably if I was to hit the number 10, it would be talent and the Treasury organization. Hiring people into a Treasury role today that have flexible skill set and can adapt with changes is critical.
Oh, that was excellent. I just meant the 10 as a general number. That was awesome.
Well, I gave you 10. I 100% gave you 10. You asked for 10, I gave you 10 survival tactics.
What are the 50 essentials, Sue?
What are the
No,
50?
that was-
I'm going to give you 100. I'm going to give you 100.
Oh, that was excellent. Talking about the people, the forecast, those seem to resonate across every size company. And it's been that way for a decade. Takes too long. They'd spend more time if they could. They would do it more frequently. Management has increased expectations. Those all fit, I think, every single organization and fit them well. Well, Sue, thank you so much for spending some time talking with me about controlling the controllables. I really appreciated it.
Well, thank you so much for having me for your guest. I appreciate it.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer